Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study exactly how they think. Today we're looking at a strategy called Andean Oscillator Trend Shift, an expert advisor built around an uncommon and rather elegant indicator, the Andean Oscillator, published by Alex Grover in 2021. It's a trend-following approach that measures the hidden strength behind rising and falling moves. By the end of this video, you'll understand how it reads the market, how it enters both long and short, and how it manages risk. Let's get into it. So what is this expert advisor actually doing? At its heart, Andean Oscillator Trend Shift is a trend-following system. It doesn't rely on a moving average, an RSI, or a set of bands like most strategies you'll see. Instead, it uses the Andean Oscillator, which approaches trend detection from a genuinely different angle. Rather than tracking one smooth line of price, it keeps four running envelopes at once. Two of them follow price itself, an upper and a lower envelope, and two more follow price squared. That may sound abstract, but there's a neat piece of statistics behind it. Because the variance of a series equals the average of its squares minus the square of its average, combining the price envelope and the price squared envelope lets the indicator compute an online standard deviation, on the fly, for the upswings and the downswings separately. The result is two components. There's a bull component, which grows as a rising market forces the lower envelope to travel upward, and a bear component, which grows as a falling market stretches the upper envelope downward. In plain terms, the bull component measures the conviction behind upside moves, and the bear component measures the conviction behind downside moves. Whichever of the two is larger tells you which side is currently in control. That larger value, smoothed by an exponential moving average, becomes the signal line, a self-adapting benchmark of how much strength the dominant side is showing. This strategy is designed to be flexible. It reads the symbol and time frame you select at backtest time rather than hard-coding anything, and its risk distances are scaled from the average true range, so it adjusts to whatever instrument you point it at. It tends to be studied on trending instruments, such as a major currency pair or a metal, on the hourly or 4-hour charts. It's most relevant for traders interested in systematic, rules-based trend following, and for anyone curious about how a statistical indicator can be turned into a complete set of trading rules. As always, this is educational information only, not financial advice, and trading always carries the risk of loss. Let's walk through the mechanics step by step. On every newly closed bar, the strategy folds the latest open and close into its four envelopes. The upper price envelope decays slowly downward but snaps up to meet any new high in price. The lower envelope decays slowly upward but drops to meet any new low. The two squared price envelopes do the same thing on the squared values. From these, the expert advisor calculates the bull component as the square root of the lower squared envelope minus the lower envelope squared, and the bear component as the square root of the upper squared envelope minus the upper envelope squared. These are, in effect, the standard deviations of the downswings and the upswings. Next, it takes the larger of the bull and bear components on each bar and runs an exponential moving average over that series. The length of that average is set by the signal period input, which defaults to 9. This smooth line is the signal, and it represents the recent, typical level of dominant side strength. Now for the entries. A long signal appears when two things are true together. First, the bull component must be greater than the bear component, meaning the upside has control of the market. Second, the bull component must cross above the signal line, having been at or below it on the previous bar. That crossing marks a fresh expansion of upside conviction, and it is the long entry condition. The short signal is the mirror image. The bear component must be greater than the bull component, and the bear component must cross above the signal line from below. That marks a fresh expansion of downside conviction and is the short entry condition. The strategy holds only one position at a time and operates as a stop-and-reverse system. If a long signal appears while a short is open, it closes the short first and then opens the long. If a short signal appears while a long is open, it closes the long and opens the short. So the opposite signal both exits the current trade and starts a new one in the other direction. Risk is handled with the average true range. When a long is opened, the stop loss is placed 2 ATR below the entry and the take profit 3 ATR above it. For a short, those distances are flipped. With the default multipliers of 2 and 3, that's a reward-to-risk ratio of 3 to 2, or 1.5 to 1, on every trade. Because the distances come from ATR, they widen in volatile conditions and tighten in calm ones, automatically scaling to the instrument. Let's read through the actual MetaQuotes language code, just as you'd see it in MetaEditor. At the top are the inputs you can adjust. AndeanLength, defaulting to 25, controls how slow and smooth the envelopes are. SignalPeriod, at 9, is the length of the exponential moving average that forms the signal line. AtrPeriod, AtrStopMult, and AtrTpMult govern the risk distances, with the stop at 2 times ATR and the target at 3 times ATR. Lots sets the order volume, and magic is the identifier the expert advisor uses to recognize its own positions. Below the inputs are the two conditions that drive everything. The long condition, long sig, is true when the bull component is greater than the bear component. The bull was at or below the signal on the previous bar, and the bull is now above the signal. That's the crossover from below. The short condition, short sig, is the exact mirror using the bear component. If neither is true, the code simply returns and waits. When the long condition is met, the code first closes any open short, applying the stop and reverse rule, then reads the ask price as the entry. It sets the stop loss 2 ATR below and the take profit 3 ATR above and calls trade.buy. The short block mirrors this. It closes any open long, reads the bid as the entry, places the stop 2 ATR above and the target 3 ATR below, and calls trade.sell. Both sides are handled symmetrically, so the strategy is equally happy trading up or down. Let's bring this to life on a chart, and I want you to focus on the panel beneath the candles. That panel shows the Andean Oscillator with 3 lines. The green line is the bull component, the strength behind upside moves. The red line is the bear component, the strength behind downside moves. And the gold line is the signal, the smoothed average of whichever component is dominant. Watch how they interact. Look at the first 3 candles on the left. Price is drifting sideways and slightly lower, just gentle chop. In the panel, the red bear line sits a little above the green bull line, and both are subdued. Neither side has real conviction, and the signal line is flat. There's no reason to act here, and the strategy stays out. Now watch the 4th candle. Price turns and closes higher, and something changes underneath. The green bull line lifts sharply and climbs above the gold signal line, while at the same time it moves above the red bear line. That is exactly the long condition we read in the code. Bull is greater than bear, and bull has crossed above the signal from below. That's a fresh expansion of upside conviction, and you can see the buy entry marker appear right there. The stop loss is placed 2 ATR below the entry, sitting under the recent lows, and the take profit target is set 3 ATR above. That's the 1.5 to 1 reward to risk we discussed. Follow the next few candles. Price presses steadily higher, each candle building on the last. And in the panel, the green bull line stays firmly on top, while the red bear line fades toward the floor. Momentum is one-sided, which is precisely the environment a trend follower wants. By the 8th candle, price reaches the take profit target, and the long trade closes for a gain in this illustration. Notice the strategy didn't try to predict the top. It simply let the target do its job. Then the character of the market shifts. Price stalls and prints a lower close, and the balance of the two components begins to flip. The green bull line rolls over and starts falling, while the red bear line turns upward as downside dispersion builds. But notice the strategy doesn't short immediately on the first down candle. The signal line is still elevated from the strong uptrend, so the bear component has to climb clearly above it before anything happens. That built-in delay is a form of confirmation, filtering out a shallow pullback. By the 11th candle, the red bear line finally crosses above the gold signal line, and by now the bear component is comfortably above the bull component. That's the short condition, and the sell entry marker appears. Because this is a stop and reverse system, if any long had still been open, it would have been closed first. For this short, the stop loss sits 2 ATR above the entry and the take profit target 3 ATR below. From there, price works its way down, candle after candle, the red bear line staying dominant in the panel while the green bull line sinks. Selling pressure carries price into a fresh low, and by the final candle it reaches the take profit target, closing the short in this example. So across the sequence, you've seen the complete cycle. A bull crossover launched a long into a rising market. The target closed it. A bear crossover then flipped the bias to the downside, and its target closed the short. That's the rhythm of Andean Oscillator trend shift, all driven by which side's conviction is expanding across the signal line. And that's a full walkthrough of Andean Oscillator trend shift. We covered the idea behind the Andean Oscillator, how it turns four price envelopes into separate measures of bull and bear conviction, how a component crossing above the smooth signal line generates a long or a short, and how the stop and reverse logic and ATR-based stops and targets tie it all together. Remember, everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation. Every strategy carries risk, and losses are a normal part of trading, so always study a system carefully and test it thoroughly before considering it. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment telling me which strategy you'd like me to analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.